Now, we've been looking at a lot of economic indicators, and we discussed yesterday about loan creation, and this is something where we need to look at this very, very closely because this is something that they really can't manipulate. And for the last, 57 years or so, it's been showing us and it's been reporting to us that either we're in a recession when loan creation completely stops or declines, or the recession's about to happen. Now, there are many more indicators that basically work with the loan creation, and we're going to get into that a little bit later in this report. And you're going to see, as we put all the pieces together, you're going to see that we're heading down this path, which I don't want to say it's scary, that we're heading down this path where things are rapidly deteriorating. And we need to look at the economy right now as maybe a drug addict, where during the period where the drug addict is receiving the high, receiving the stimulus, they feel great, everything looks great, they feel great, there's no problems whatsoever. And when the drug wears off, they start going through different signs of withdrawal. And this is what we're seeing the economy go through right now. The stimulus that has been pumping this economy up, it's wearing off, and we're seeing signs of withdrawal. And it's getting worse and worse as time goes on. And we can see right now that it's not just here in the United States, but it's around the world. And the central bankers, the deep state organization, they know this. They know what's going on. They know what's about to happen. And they can slow it down. They can speed it up. They have full control of the system. The only thing they really don't have control of is something that comes out of left field. And if something does come out of left field, well, they can either go with it or they could try to stop it. But most of the time, once that starts happening and people see what that happening, the whole system starts to fall apart. Now, out in Spain, we see that the banks, they're really in a lot of trouble right now. They've been bailed in right now. There's other banks that are not looking good. And we can see the Spanish securities regulators, well, they know there's a problem because what they've done already is they decided to ban something. And they banned the sale of borrowed shares for a month. Now, they're saying that market confidence has deteriorated in relation to a part of the local banking sector. And the ban prohibits investors from starting new short positions or to adding to existing ones. This tells you that they know these banks are coming down. They don't want people to short these banking systems. And they put a ban. They said, no, you can't do it. I'm sorry. We know it's coming down and you just can't do any of this. And if you have already a position, you just can't add to it either. So they're stopping individuals from doing this. Now, what are we seeing happen? Well, here in the United States, we know that retail is contracting quite a bit. The U.S. retail sector, well, there are more and more stores that are going to be declaring bankruptcy. Moody's is out there, and they have this whole entire list of all these different stores, and they keep upping the list. Now, they started at 19, or actually they started at 15. They brought it up to 19. Now there's 22 stores, and they might be adding an additional 5 to this, saying that these are the stores that are in major trouble, and these stores are going to be going bankrupt. I think by the end of this year, you're going to see maybe 50, 60, maybe even 100 stores that are going to go bankrupt. I think this list is conservative right now. I think it's going to go much, much higher than this. Because we can see already the numbers that they've been putting out there, they've been showing that, well, it's not going to be the 8,000 stores. It's going to be close to maybe 10, next year around 13. I think this number is going to be even higher than what they're saying, because what we're seeing right now is a complete breakdown of the system. We're seeing in the restaurant industry, actually the chain restaurant, they're already in a recession. Their whole system is breaking apart. Because right now, they're in a 15-month downturn. This is the longest since 2009. And there's no end in sight. Why? Because people don't have the discretionary income to go out and purchase this food. Because there's more and more people losing their jobs. We see already in the stock market, there's a tech stock bloodbath. We look at Amazon, Apple, Google, Microsoft, all turning down. And we have to remember that these are the companies that keep the S&P 500 up. If all these companies are turning down, well, there's a major problem right now. Now, yes, will they be pumped up once again? Most likely. Remember, Who's purchasing these stocks? The central banks, governments. They're the ones who've been propping the market up. This is not a real market. This is a complete illusion. But this is a warning right now that even though they're propping the stocks up and they're continually purchasing, there's major problems here. Now, one of the big problems, and we discussed it yesterday, is loan creation. That is stalling right now, and it's starting to decline. We saw it in commercial loans. We see it in auto loans. We see it in housing loans. And we understand that the debt continually increases. It's not going anywhere. It's not going down. It's not stopping. It's continually increasing. The government is continually spending more and more money, which means they have to borrow more money. And they depend on the federal tax receipts to pay for all this. They depend on state tax receipts for the states to pay for their debt. And what we're seeing right now, and this is coming out of the Rockefeller Institute and CBO, the U.S. federal income tax receipts have come in about 3% below expectations this year. We are hovering around 0% right now on year-to-year percentage of the number of tax receipts coming into the government. We're heading in a downward trend just like we did prior to 2008 going into 2008. Now, if we look at state and local tax receipts, they are declining at the same rate. So we have problems here. Now, if we look at the state and corporate tax receipts, for 2 quarters in a row, they have been declining. This is the biggest drop since the recession. And according to the Rockefeller Institute, total state tax collections grew only 1.2% in the year of 2016, which means it declined in real terms. This is the weakest performance in 2010. Now, on a federal level, it will impact the amount the government has to borrow to fund its deficit, therefore determining when the government will hit the debt ceiling. This is quite relevant today since the debt ceiling was officially reached on March 17th, and of course, as we know, it's been extended using extraordinary measures. Basically, what they're doing is they're using black pools of money to keep the government operational. However, the weakness in these tax receipts, this is going to create a challenge, which means that the debt ceiling date might move up, which I think it's going to. And these tax receipts, because it's one of the few unvarnished, unadjusted, realistic data points regarding the health of the overall economy, well, economists look at this and say, the country's doing well, the country's not doing well. And the tax receipts, they are a function of income creation in the economy. A slowdown in the tax receipts indicates a slowing in income creation and therefore overall economic performance. Now, we knew this was happening. How did we know this? Well, we've been tracking the job market, not the fake unemployment numbers. We've been tracking exactly what has been happening in the retail sector, in the corporate sector. We've been using data from Challenger Gray and Christmas. Because remember, back in 2013, that department that counts layoffs, well, that department was removed. They're saying they didn't have the funds to keep it operational. Well, they did that on purpose, of course. So growth in federal tax receipts, these trends are showing us that people are making less money, people are out of job, and the number of tax receipts coming into the government, well, it's not happening. They're declining at a ridiculous pace. And this deterioration in federal tax receipts is very troubling. So we have loan creation, which is very difficult to manipulate. We have tax receipts, very difficult to manipulate, showing us that we have major problems. Actually, it is back to where we were back in 2008, 2009, when we were in this crisis mode of this Great Recession. And again, these are the withdrawal symptoms of the economy coming off of stimulus. So now, the Treasury, they came out with their report on their monthly receipts and outlays data for the month of May, at outlays of $329 billion, soared by 19%. That's the money that they're spending compared to a year ago, offset by a modest 7% increase in receipts, resulting in a $88.4 billion deficit in May. And we know the government is spending a lot more than they're taking in. And what's being taken in is continually dropping. this is not a good sign. Now, add on top of all of this, and we talked about this before back in January of 2016, about how the credit impulse has gone negative. And we looked at it, it's at -1, very close to -1. And this is what happened during the Great Recession. Fast forward to today, 3 months later or so, where are we now? Well, UBS is letting us know. They released the update of the current state of the global credit impulse, and it's a complete disaster. What we're seeing is that we are now down to -3%. Credit has gone negative. It is getting worse, which means that credit is going to freeze up. What actually happened in 2008? Credit froze up. If we go back to that time period, right where we were between 2007 2008, we were at -2% at 2008. We are at -3% in 2017. And by the way, people, this is a recovery. The economy is recovered with a -3% credit impulse. So let's put all this together. Tax receipts are declining, federal and state. Corporate tax receipts are declining. Loan creation is stalled and declining. Credit impulse, well, tells us credit's freezing up. Put all of this together, we have a major problem. Now that's global credit impulse. What about the U.S. credit impulse? Well, we have the same exact problem. The U.S. credit impulse is also slowing. It has just dropped to like -0.1%. And it dropped in the end of 2007 going into 2008 to -0.1%, the same thing that we're seeing. Once again, we're in that same exact position. And it's showing us that credit is going to freeze up and we're going to be in this collapse scenario. Forget about a recession. We're already in the recession. And what is the Fed going to do this week? They're going to look at the economy, they're going to have their Fed meeting, and they're going to decide, should we raise the rates or should we lower the rates? Or should we keep them the same? Well, we know they're not going to lower it. That'd be ridiculous. They can keep it the same, yes. Now, I think the last rate increase already triggered the economy because since that period of time until now, the economy has turned to the downside and it has accelerated. And we've been looking at all these economic indicators, and it is really getting worse and worse and worse. So let's look at both sides here. We know they've already triggered the economy, and it is collapsing right now. Now, they can go ahead and say, listen, we're not going to raise the interest rates. We're just going to let the economy slide off the cliff the way it is, and we'll just let it go naturally, maybe by the end of this year. If the Fed decides that they're going to raise the interest rates, well, look out. Which means they don't want to wait to the end of this year. They want it to happen now. They are worried that there's going to be some type of black swan event. They don't want this to happen because they need to control the narrative. If they raise the rates, they're going to accelerate the collapse like we've never seen before. We think we're getting bad data now. Just wait. You're going to see things go haywire when they raise rates. Now, of course, the next day, you're not going to see it. A month later, you will see it. 2 months later, you will see it. And I think what they're going to do is most likely raise the rates because I think they're very worried that there's going to be a black swan and they're going to lose the narrative. And I think they're going to raise the rates. I mean, I could be wrong. They could just let it play out and it's going to crash anyhow. If they raise the rates, we're going to see an acceleration in the collapse of the economy, which should be a signal to everyone to start ramping up your preps because they just signal to you, yeah, just like they did back prior to 2008 when they were raising the rates, we're crashing the economy. Now, they didn't have to do as many as they did prior to 2008 because this whole economy was been propped up on stimulus. And it was very easy to bring down. It's really not that hard. And of course, they're not going to throw the switch in the back room to bring it down because they need to make it look natural. And this is what they're doing. So we see right now that this is where they're headed. If they do this, this is your signal, And I would batten down the hatches, get prepared. This is not to scare everyone. I mean, if you think about it, for those people who were caught up in 2008, if you had all these warnings ahead of time where, hey, you were looking to buy that house at the height of the market, maybe you wouldn't purchase that house. Maybe if you were going to sell your house, you would have done it maybe 2 years ahead of time, taken the cash, maybe put it in gold or silver, or put it into some other type of investment, maybe even the stock market, just to play it for a little while, then take it out and, make your wealth or whatever you were going to do. But you could see if you had this information, you would have been ready and prepping. For those people that were just going to stay in their house, they would have made preps to say, okay, I might lose my job. I better prepare for what is coming. I better have food and just be ready for the entire economy falling apart. This time it's a little different because the stimulus is really not going to work. Now, when the economy comes down, will they try stimulus? Of course they will. Will it work for a very short period of time? Maybe. But what's going to eventually happen is the economy is just going to turn down because they already know that the stimulus didn't work the last time. And I'm talking about the rest of the world. And they're going to look at the U.S. dollar. They're going to look at the U.S. economy. They're going to look at the global economy saying, you know something? It's a complete disaster and everything will continually collapse. And you'll see country after country collapse. The United States will collapse. And the whole thing will be a complete nightmare. This is what we've been preparing for. This is what we've been getting ready for. And we can see from all these different things, they're all converging on this at the same time. And things really don't look good. And we're going to wait to see what the Fed does because we're going to see if they're going to let it out, give us a little bit more time, not that much more time, or accelerate the process and bring the whole system down in a short period of time. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared.